Welcome to Mortgage Matters, the podcast on all things mortgage related. Whether you're a first-time buyer, buying your next home, or simply curious about the world of mortgages, this is the podcast for you. Join us as we delve into the intricacies of the mortgage industry. We're going to uncover valuable insights, expert tips, and more to help you navigate the complex world of home financing. From understanding different types of mortgages to demystifying loan jargon, from maximizing your borrowing power to managing your mortgage payments. Mortgage Matters covers it all. So, tune into Mortgage Matters and empower yourself with the knowledge you need to make informed decisions about one of life's most important financial decisions. Welcome back. In today's episode, we're going to delve into one of the most critical aspects of the mortgage approval process, your credit score. Imagine standing at the threshold of your dream home, keys in hand, ready to embark on a new chapter of stability and independence. The vision is within your reach, but a crucial factor can significantly influence your ability to secure the mortgage, your credit score. This seemingly simple number carries so much weight, and it affects your mortgage approval and the terms and interest rates you'll receive. At First Nation Financial, we understand that many potential homeowners find the concept of credit scores daunting. However, understanding and improving your credit score is vital to making your home ownership dreams reality. Today, in this episode, we're going to explore the fundamentals of credit scores, their impact on your mortgage options, and practical tips to boost your score. So whether you're starting your home buyer journey or looking to refinance your current mortgage, having a strong credit score will provide you with more opportunities and better terms. Here's what you're going to find in today's episode: understanding credit scores, how different credit score ranges affect mortgage interest rates, an overview of the credit score requirements for conventional FHA, VA, and jumbo loans, and practical steps you can take to boost your credit score. And by the end of this episode, you're going to have a comprehensive understanding of how your credit score affects your mortgage prospects and actionable strategies to enhance your credit profile. So let's dive in. First, what is a credit score? A credit score is a 3-digit number, typically 300 to 850, reflecting your credit worthiness. Basically, it's a snapshot of how reliable you repay debts. This score comes from your credit report, which details your credit accounts, payment history, outstanding debts, and other financial behaviors. The most commonly used credit scoring model is the FICO score, but there are others like the Vantage score. A higher score generally indicates better creditworthiness and lower risk to lenders. So, how are credit scores calculated? Credit scores are calculated based on a few different factors, each contributing a specific percentage to the overall score. There's your payment history, which is about 35%, and this is the most significant factor. It reflects whether you've paid last credit counts on time, late payments, delinquencies, and defaults. That can significantly lower your score. So, paying your bills on time is crucial. The next one is amounts owed, which is about 30%. This factor considers the total amount of debt you owe and how much of your available credit you're using, known as the credit utilization ratio. High balances relative to your credit limits can negatively impact your score. Keeping your credit card balance low can help maintain a good score. Length of credit history, that's about 15%. A longer credit history generally improves your score, giving more information about your financial behavior over time. This is why it can be beneficial to keep old accounts open, even if you don't use them much. And your credit mix, which is about 10%. Having various credit types like credit cards, installment loans, and mortgages can positively influence your score. It shows lenders that you can manage different types of debt responsibly. And finally, new credit, which is about 10%. Opening several new credit accounts quickly can lower your score, as it might indicate high risk. Multiple hard inquiries when lenders check your credit report can also temporarily decrease your score, so you need to be strategic about applying for new credit. Why does credit score even matter? Your credit score plays a really crucial role when you're looking to secure a mortgage, and here's why. First, your mortgage approval. Lenders use your credit score to determine your mortgage eligibility. A higher score increases your chance of approval, while a lower score might lead to rejection or needing a cosigner. Your second is your interest rate. Your credit score significantly impacts the interest rate of your mortgage. Higher scores generally qualify for lower interest rates, which means lower monthly payments and less interest paid over the life of the loan. This can save you thousands of dollars in the long run. And finally, your loan terms. Beyond approval and interest rates, your credit score can affect other loan terms, like the size of the down payment required and the availability of certain types of loans. A higher score can provide you with more favorable terms. How can you take control of your credit? Understanding the components and significance of your credit score is the first step towards improving it. You can boost your credit score by monitoring your payment history, maintaining a long credit history, having a good mix of credit types, and being cautious about new credit inquiries. Improving your credit score takes time and discipline, but the benefits are worth the effort. With a higher score, you have more opportunities and better terms when securing a mortgage, bringing you closer to your dream of home ownership. So take control of your credit today and pave the way for a brighter financial future. Let's look closer at credit score ratings. Here's a general overview of how different credit score ranges can affect the rates you're offered. First is excellent, which is 750 and above. You are in an excellent position if your credit score is 750 or higher. Borrowers with scores in this range usually receive the best interest rates that are available. Lenders view these borrowers as low risk, so they offer competitive rates to attract them. This means you're going to pay less interest over the life of your mortgage. 2 is good, which is 700 to 749. Having a credit score between 700 and 749 is quite favorable. You'll receive good interest rates, though they might be slightly higher than those borrowers in the excellent range. Lenders consider you low risk, but not as low as those with excellent scores. You can still expect favorable terms and manageable monthly payments. And 3 is fair, which is 650 to 699. With a credit score in the 650 to 699 range, you may face higher interest rates. Lenders see you as a moderate risk, which means they'll offer higher rates to mitigate the potential risks. While you can still qualify for a mortgage, the increased rates can lead to higher monthly payments and more money paid in interest over the life of the loan. 4 is poor. A credit score between 600 and 649 puts you in the high-risk category. Lenders will likely offer a significantly higher interest rates, which can substantially increase the cost of borrowing. You might still get approved for a mortgage, but the terms won't be as favorable, and you'll pay more in interest. And 5 is very poor, which is below 600. If your credit score is below 600, qualifying for a mortgage becomes very challenging. Lenders see you as high risk. If you manage to secure a mortgage, the interest rates are going to be a lot higher, and lenders may require additional guarantees, such as a larger down payment or cosigners to offset the risk. Let's look at some real-life examples. Imagine you're looking at a $300,000 mortgage with a 30-year fixed rate. If you have an excellent credit, you could get an interest rate at about 3.5, making your monthly payments approximately $1,347. Over 30 years, you're going to pay about $184,968 in interest. If you have a good credit, you'll have a slightly higher rate at 3.7. Your monthly payments could be around $1,389, and you'll pay about $199,640 in interest. If you have a fair credit, you'll have about 4.5%, and your monthly payments will jump to $1,520, and your total interest will hit about $247,680. And if you have poor credit, you'll be at about 5.5, and that means you pay $1,703 a month, and you're going to pay $313,080 in interest. So as you can see, even small differences in interest rates can lead to substantial changes in your monthly payments and the overall cost of your mortgage. Understanding how your credit score affects mortgage rates and loan term is very important. You can secure better rates and save money in the long run by just improving your credit score, such as paying bills on time, reducing debt, and avoiding new credit inquiries. Your credit score is a powerful tool in your financial toolkit, so take charge of it in order to achieve your home ownership goals. When planning to buy a home, your credit score influences more than just your interest rate on your mortgage. It can also affect various other aspects of your loan. Here are 3 key factors to keep in mind. 1. Private mortgage insurance. Private mortgage insurance is a type of insurance that protects the lender in case you default on your loan. If your credit score is lower and your down payment is less than 20% of your home purchase price, you may be required to pay your private mortgage insurance. This can add a significant amount to your monthly mortgage payments. On the other hand, if you have a higher credit score, you may be able to avoid private mortgage insurance altogether and pay a lower rate, saving your substantial amount of money over time. 2. Loan approval chances. Your credit score plays a crucial role in determining whether you get approved for a mortgage in the first place. Higher credit scores help you secure better interest rates and increase your chances of approval. With a higher score, lenders see a lower risk borrower, making your mortgage application more likely to be approved. Also, lower scores might limit your options, often restricting you to more expensive or less favorable loan products. This means higher interest rates, more stringent terms, or even needing a cosigner to help you qualify. Understanding how your credit score impacts mortgage rates and other loan terms is vital for prospective home buyers. A better credit score can mean the difference between securing a loan with a manageable monthly payment and affordable terms or struggling with higher costs and less favorable conditions. By striving to improve your credit score, you can unlock numerous benefits. Lower interest rates. This means lower monthly payments and less interest over the life of the loan. Reduced PMI costs. Higher scores can help you avoid or minimize PMI, lowering your overall mortgage costs. Increased approval chances. A higher score makes it easier to get approval, giving you access to a wider range of loan products with better terms. When securing a mortgage, the type of loan you choose significantly impacts the minimum credit score requirement you'll need to meet. Here's a breakdown of the credit score requirements for 4 loan types and how they influence your eligibility and terms. First is conventional loans. Conventional loans are the most common type of mortgage and not backed by the government. They generally have strict credit requirements. Minimum credit score to qualify for conventional loan is about 620. However, to secure the best interest rates and terms, you should aim for 740 or higher. When it comes to the down payment, while it is possible to qualify with a score of 620, you need a large down payment, or you're going to face high interest rates compared to those with higher credit scores. Generally, a down payment of at least 5% is required, but having a higher credit score can lower this requirement. 2. FHA loans. FHA loans are insured by the Federal Housing Administration and are designed to help first-time homebuyers and those with lower credit scores. The minimum credit score you'll need is about 580 in order to take advantage of the low down payment option of 3.5%. But if your score falls between 500 and 579, you can still qualify, but you'll need a down payment of at least 10%. FHA loans are known for being more lenient with credit scores, making them a popular choice for borrowers with past credit issues. This flexibility makes homeowners more accessible to a broader range of people. 3. VA loans. VA loans are available to eligible veterans, active duty service members, and certain National Guard and Reserve members. As far as a minimum credit score, the Department of Veteran Affairs does not have a minimum credit score requirement for VA loans. However, most VA loan lenders typically require a minimum score of around 620. Some lenders might accept lower scores if other qualifying criteria are met. And the advantages: VA loans offer significant benefits, including no down payment requirements, no private mortgage insurance, and these advantages make VA loans an attractive option for those who qualify. And 4, jumbo loans. Jumbo loans finance properties that exceeds the conforming loan limits set by the Federal Housing Finance Agency. They are often used for luxury homes or high-cost areas. Now, due to the large loan amount, jumbo loans usually require a minimum credit score of 700 to 720, and some lenders are even stricter than that. Because jumbo loans carry more risk for lenders, borrowers must demonstrate strong creditworthiness and financial stability. This typically involves a high credit score, significant assets, and a solid income history. Understanding the minimum credit score requirement for different loan types is really crucial for a few reasons. First, it helps you set realistic goals. Knowing the credit score you need allows you to achieve financial goals. If your score is below the required threshold, you can work towards improving it with targeted strategies. 2, choose the right loan. Matching your credit profile with the appropriate loan type increases your chance of approval and helps you secure better terms. Different loans have different requirements, and being aware of these help you make informed choices. 3, plan your home buying journey. Knowing these requirements enables you to plan your home buying journey more effectively. You can ensure you meet criteria before applying, which saves time and reduces the risk of application rejections. Understanding these requirements helps you navigate the mortgage landscape more effectively. Now, let's move on to practical tips for improving your credit score, empowering you to qualify for better loans. Improving your credit score can significantly enhance your chances to secure a mortgage with favorable terms. And here are 10 practical tips and resources to help you boost your credit score. 1, pay your bills on time. Your payment history is the most significant factor in your credit score. Late payments can have a severe negative impact. Set up automatic payments or reminders to ensure you pay all your bills on time, and use apps like Mint or Prism to track and manage your bill payments. 2, reduce your credit card balances. Another critical factor is the amount of debt you owe relative to your credit limit. Aim to keep your credit utilization below 30%, ideally below 10%. Pay down high balances and consider requesting a credit limit increase, but don't increase your spending. 3, avoid opening new credit accounts. Every time you apply for new credit, a hard inquiry is recorded in your credit report, which can temporarily lower your score. Avoid opening new accounts unless absolutely necessary. If you're shopping for a mortgage, do your rate shopping within a short period, usually 30 days, to minimize the impact of multiple inquiries. 4, keep old accounts open. The length of your credit history contributes to your score, even if you're not using old credit accounts. Keeping them open can benefit your score by showing a larger credit history. Use old accounts occasionally to keep them active and pay off any balances immediately. 5, diverse your credit mix. Having a variety of credit types, like credit cards, installment loans, mortgages, can positively impact your score. If you only have one type of credit, consider diversifying, but do so cautiously. If appropriate, consider a small personal loan to diversify your credit mix. 6, regularly check your credit report. Errors on your credit report can lower your score. Regularly check your credit reports to ensure all information is accurate and up to date. Visit annualcreditreport.com to get a free credit report from each bureau once a year. 7, dispute inaccuracies. If you find errors on your credit report, dispute them promptly. Correcting inaccuracies can quickly improve your credit score. Write a dispute letter to the credit bureau or use their online dispute process. Include documentation supporting your claim. 8, manage debt responsibly. Create a plan to pay down existing debt and avoid accumulating new debt. Prioritize high-interest debt first to reduce the overall amount you owe more effectively. Consider using debt management tools or consulting with a credit counselor for personal advice. 9, limit hard inquiries. Hard inquiries occur when a lender checks your credit report as part of the loan application. While they are necessary for obtaining new credit, too many can lower your score. Be strategic about when and why you're applying for new credit. Limit the number of applications to those truly necessary. And 10, use credit building tools. Consider tools designed to help build or rebuild credit, such as secured credit cards or credit builder loans. Companies like Self and secured credit cards from major banks can help establish or improve your credit history. When you implement these tips, you can improve your credit score over time, increase your chances of securing a mortgage with favorable terms. These proactive approaches to managing your credit will help you achieve your home ownership goals and provide financial benefits in other areas of your life. Improving your credit score is not just about numbers, it's about unlocking opportunities and opening doors to your dream of home ownership. By taking proactive steps to manage your finances and build a solid credit history, you're enhancing your chances of securing a mortgage and laying the foundation for a brighter financial future. At First Nation Financial, we understand that navigating the complexities of credit scores and mortgages can feel overwhelming, and that's why we want to simplify the process and guide you every step of the way. Our team of experts is dedicated to helping you understand your credit profile, explore your mortgage options, and confidently achieve your home ownership goals. Don't let credit score hold you back from the home of your dreams. Take control of your financial destiny today by implementing these tips and contacting First National Financial for personalized assistance. Together, we're going to navigate the maze of confusion and lead you to the other side where home ownership awaits. Contact us now to begin your journey towards a brighter future. Ready to take the first step towards home ownership? Contact First Nation Financial today to schedule a consultation with one of our experienced professionals. Together, we'll make your dream of owning a home a reality.